Most people who try to beat the stock market, even MBAs and professional investors, simply don't succeed. But what if I told you that there is a way small investors like you and me actually can? It sounds too good to be true, right? Well, Joel Greenblatt, a legendary investor and Columbia Business School professor, lays out a simple but powerful plan in his book, The Big Secret for the Small Investor. Let us break down the 5 biggest lessons that can help you outperform the market, and even the pros. So, how can a small investor possibly beat someone like Warren Buffett? Greenblatt gives a fun example. How would you beat Michael Jordan? You don't play him in basketball, you pick another game. It's the same in investing. Buffett invests in huge companies like Apple and Coca-Cola because he manages billions of dollars. He simply can buy small companies. They read too tiny to make a difference in his portfolio. That's where your advantage lies. As a small investor, you can invest in smaller companies, the ones Buffett and big funds can't touch. A company with a market cap under $1 billion is often ignored by big players. And guess what? There are hundreds, even thousands, of such companies offering amazing opportunities. Your goal is not to play in Buffett's Diamond League. Play in the Bronze League, where competition is low and upside is high. Because at the end of the day, a 15% return is still a 15% return, no matter where it comes from. The secret to successful investing is simple. Figure out the value of something and pay a lot less. Benjamin Graham called it investing with a margin of safety. It means buying at a big discount, so even if things go wrong, you're still protected. Now, many people try to value a stock using discounted cash flows, predicting future earnings and discounting them back. But here's the problem. No one can predict a company's earnings 30 years into the future. Even professional analysts struggle to predict next quarter's numbers. So instead of trying to find the exact value, Greenblatt suggests comparing relative value. Which stock is better compared to another? It's like this. You might not know exactly how much Jupiter weighs, but you definitely know it weighs more than Pluto. Similarly, you might not know Apple's exact fair value, but you can decide whether Apple is cheaper or more expensive than Google. To start, make sure any stock you buy gives a return higher than your opportunity cost, say 6%. If a stock can't beat that, skip it. Then, compare the rest based on how cheap and how profitable they are. That's where Greenblatt's magic formula comes in later. You've probably heard this advice, just buy the index fund. It's the safest bet. And yes, index funds have beaten most active managers. But Greenblatt points out a big problem. Index funds buy more of what's expensive and less of what's cheap. Here's an example. When Disney stock goes up, it becomes a larger part of the index. That means index funds automatically buy more of it at higher prices. And when the price falls, they buy less of it, the opposite of what smart investors should do. During the dot-com bubble, index funds loaded up on overpriced tech stocks. After 9/11, they avoided airline stocks, even though those were bargains. So, what's the fix? Greenblatt suggests equal weighting or fundamental weighting, giving each stock the same weight or weighting by things like earnings, sales, or book value. Studies show these approaches outperform traditional market cap indexes by 2.5–4.5% per year. But Greenblatt believes we can do even better. Here's the big idea. Create your own value index. Instead of trying to predict exact values, just rank stocks based on 2 simple things. 1, how cheap they are, like using the PE ratio, and 2, how good they are, like using return on capital. Then buy the ones that score the best on both. This is the basis of Greenblatt's famous magic formula. He tested it between 1990 and 2010, and it crushed the market. The magic formula returned 13.9% per year, while the S&P 500 returned around 7.6%. If you started with $10,000, after 20 years you'd have about $135,000 with the value index, versus only $43,000 with the S&P. So remember this order of performance. Market cap indexes beat most managers. Equal-weighted and fundamental indexes beat market cap indexes, but value-weighted indexes beat them all. Finally, Greenblatt warns about the biggest threat to your returns, your own emotions. Humans are not built to be good investors. We fear losses more than we enjoy gains. That fear causes us to sell low and buy high. Even top fund managers struggle. Half of the best-performing managers in 1 decade spent at least 3 years in the bottom 10%. Most investors, and their clients, can't handle that kind of patience. That's why Greenblatt tells small investors to tie themselves to the mast, like Odysseus did when facing the sirens. Set your plan, and don't let emotions pull you off course. Here's his advice. Rebalance only once a year. Don't check your portfolio every day. Once a month is enough. Keep 40–80% of your money in stocks, depending on your comfort level. Only adjust this once a year, by no more than 10%. The less you tinker, the better your results. The real secret is patience. In a world obsessed with instant results, having a long-term mindset gives you a huge edge. That's the big secret for small investors. So, to recap, beat the pros by focusing on smaller stocks. Use opportunity cost to choose wisely. Avoid flawed market cap indexes. Build your own value index using cheap and high-quality companies. And most importantly, stay disciplined for the long run. Joel Greenblatt likes to joke that this big secret will always remain a secret, because hardly anyone bought the book. But now you know it. So, take the knowledge, stay patient, and let compounding do its magic. Thanks for watching, and if you enjoyed this summary, don't forget to subscribe for more insights into timeless investing wisdom.